Chapter 9, Mortgage Structure and Jargon. Hi, welcome back. In today's video, we're discussing mortgages again in a bit more detail, and we're going to bust through some jargon to alleviate a little bit of confusion you might be feeling. All right, let's talk more about the technical details of financing your first home. The maximum term for mortgages is generally 30 years, but if feasible, it can also be set up on a reduced term. In fact, we recommend this where possible. Loan payments can be made weekly, fortnightly, or monthly, depending on the bank, but from our experience, it's best to pay your mortgage as often as you're paid. Paying more frequently can result in slightly lower interest costs, but this varies between banks. Squirrel can advise more on this. Interest-only terms are available to customers in most instances, provided they have an equity position of 20 to 30% of their current property value. However, some banks won't allow interest-only payments on lending secured by the family home. The interest-only terms can vary depending on the lender to a maximum term of 5 years. Fixed-rate mortgages give you certainty. You'll know your repayment amount for a fixed term of between 6 to 10 years with some lenders. Even if interest rates go up or down, you pay the same, so you could miss out on savings or avoid paying increases. If you repay a fixed term early, like if you sell the house, you may end up having to pay early repayment fees. This mortgage type is generally way overcomplicated and not very common in New Zealand. Essentially, you get a floating rate that's capped in the event that rates go up, but you pay a higher rate for that privilege. Floating rate mortgages give you more flexibility to pay off your loan faster. The rate can go up and down at any time, but this movement is closely tied to the official cash rate. With a floating mortgage, you can pay it off as fast as you like without fees, and some banks let you redraw funds if you've repaid more than their minimum requirement. This is essentially a giant overdraft on your transaction account where the overdraft is at floating mortgage rates. As long as you can resist the temptation of using all that credit for fun things like shoes and holidays, there are a couple of great benefits. It's better to throw all of your savings at the mortgage and have undrawn funds in a revolving credit, which reduces your interest payable. It gives you easy access to funds and can smooth your mortgage if your income is lumpy or irregular. It can also be a great option for people who are self-employed or contractors, or if you're planning to have a family. An offset mortgage gives you similar interest savings to a revolving credit, but rather than having to put your surplus funds in one pool, it lets you use up to 50 different accounts to offset the balance on a floating loan linked to those accounts. This product is great if you like to keep separate accounts for different purposes, like holiday savings or renovation savings. There's just a couple more things to note that you'll come across. If you need to borrow more than 80% of the purchase price of your new home, banks will charge you either a low equity fee or a margin. Both have pluses and minuses. A low equity fee is a one-off charge which can be added to your mortgage, so you don't have to cover it up front. The advantage of this is that you pay it and move on. A low equity margin is added to the mortgage rate and stays on the mortgage until you've gathered enough equity in the property. If you're able to pay off the loan quickly or get additional value into the property through renovation, this can be much less costly than a one-off fee. Most often, you can't remove the margin until your fixed rate is due, which means that even if you happen to drop below 80% LVR, you can't move the margin unless you break your loan, which may incur break costs. The only exception to this is BNZ, who will remove the margin in the middle of the fixed term. Well, that's a wrap on mortgages. Hopefully you've learned a little bit about what you can expect to be discussing with your advisor when you're locking in your first home. This is not the end though. There's more help to guide you through the entire home buying process. We'll see you again soon.